So what's the market's reaction to this whole downgrade? And I think the first thing we would like to highlight is that there was already plenty of concern in the backdrop. It was already tenuous. You had concerns with unemployment starting to rise again, and with the threat of it staying stubbornly high, while growth started to diminish. You had financial companies like Goldman Sachs lowering their estimates for growth. You had the whole wrangling over the debt ceiling, which didn't so much show that our government wasn't going to come to a deal, but it really emphasized that the deal that they were going to come to wouldn't be meaningful enough in order to impact the trajectory of the debt they were taking on. Of course, you had the economic woes of Europe. You have the concern of China's economy overheating. And if China's economy overheats, and they are the engine of growth currently in the world, where does the growth come from? As we'd outlined in our previous commentaries, we had an overvalued equity market. And then, of course, you had the Fed's QE2 program, which had come and gone with little questionable benefit. And now any future hopes of quantitative easing really coming to the aid of the markets being less and less of a hope. You had all that as a backdrop leading up to this. And so I think it's important to point that when the markets have that fragile of a backdrop, it's easy to spook the markets. But also I think it's important to note that actually the decline in the market started well before the downgrade. The S&P topped out at July 22nd and started to drop since then. You had 10-year yields topping out there around 3% before they started their precipitous decline, but the downgrade didn't come until August 5th. If you think about volatility in the lower left corner, which is a measure of fear in the system, it was at a very low 17.5, and it jumped up to an astronomical 45, which is more than double long-term averages. So you had a lot of fear really starting before the downgrade took place. What is also interesting is that what you would expect with a downgrade would be that the cost of borrowing should rise for that organization or for that country. But quite the opposite happened. In fact, 10-year yields continued to decline as investors continued to buy the Treasury. Also, you'll notice on the right-hand side of the page there, I show a chart that shows the cost of bond insurance, and this is measured in credit default swap pricing. That's what CDS stands for. But what it's showing is that versus 3 other countries, France, UK, and Germany, which are all still AAA, and remember, concern has been rising recently about France because of the Eurozone problems, and yet S&P, the same rating service that downgraded the U.S., maintained their AAA rating on France. You can see that the cost to insure your bonds that in France are actually triple what they are for the U.S. So the market is clearly disagreeing with S&P's downgrade of U.S. bonds. I think the other interesting thing to note about this market trading action is actually if you look at the demographics of the trading, or who was actually doing the trading. Who was noticeably absent from the trading floor were the large institutions and the mutual funds. And what that means is who's left to trade are the high-frequency trading platforms. That means the program trading, the computer programs and the algorithms that the high-frequency traders are set up to run automatically. And what you have is the market hits trigger points, and then you have a self-reinforcing cycle either up or down. And that's caused a lot of the big swings there. But also interesting has been the unified direction of the trading. There's been less discrimination on any given day with certain asset classes being up and certain down. Rather, everything's been up or everything's been down. And again, these signals really point to the fact that this has been not valuation-driven, not fundamentals-driven, but really more trading-driven and emotionally driven on the retail level. So, fundamentally, what we're pointing to with all those little details is that nothing has really changed fundamentally in the big picture. But let us show you what has happened to equities kind of over this time frame. If you look at the chart there on the bottom of the page, what we have is we have that red straight line that runs across the graph at 14 times. That's kind of the long-term valuation metric. That kind of gives you a benchmark to look at where fair value for stocks is. The top blue line, the price to long-term earnings, is our favorite metric for measuring valuation on stocks. And what we've emphasized, as you can read in our commentaries, is that stocks have been overvalued going into this year. And with the most recent market correction, in our opinion, stocks got close to touching fair value, but then they have popped back up. And with today's trading, as the market is closed, I believe we're actually up closer to 15 times now, so we've come up a little bit. Compare that to what the financial media likes to track, which is the price to current earnings, which are very volatile. And you'll see that even coming into this year, stocks have been a little bit on the high side from their perspective, but now that's the reason you have a lot of media pundits really screaming that stocks are a solid buy at this level. We tend to disagree. We believe that stocks are more attractively valued than what they were before, but still not extremely cheap. In terms of then what this means for our 10-year outlook on stocks, we wanted to give you a simple breakdown of how we would calculate the expected returns on stocks over the next 10 years. The left-hand side of this chart really shows the long-term average of returns on stocks and where that return has really been comprised of. And then on the right, what we have is we have our estimate for the next 10 years, which this was actually as of yesterday at a level of 1130 on the S&P. We had projected returns of about 6 to 8% returns. Not horrible for stocks, but certainly not above long-term averages. You can see that dividends are not likely to contribute as much as they have in the past. And of course, inflation could be a big concern going forward. We put in inflation between 3 and 4%. If inflation is higher, that could dramatically change earnings. But the one other thing I want to point to is the PE expansion. With PEs where they are here, we would not expect them to contribute to any meaningful return at all for stocks over the next 10 years. The important thing, I think, to point out is that the global problems still exist. So even though valuations for stocks have come down slightly, we have not worked through all these issues. In fact, we're still waiting to see what happens with Europe, what happens with the U.S. and its debt. We're still at the beginning stages of a lot of these scenarios. So that's the reason we want to really maintain our holding in equities. And you can see here, we've got this chart that really outlines some different inflation scenarios and historically how some different asset classes have done. And just to show you, if you look at equities, for instance, really with the exception of a high and rising inflationary environment, equities have done a pretty good job historically of hedging most environments. Right now, we're in a low inflationary environment, and we believe we're in a rising inflationary environment as well. That's one of the reasons why we believe it's prudent to at least hold on to some equities, even though we believe they're not extremely cheaply valued. You can also see the value of commodities during that scenario as well, at least from a historical basis.
You know, when we look at the concerns, and I know for many of you in the meetings that we've had, we've talked about these concerns, you know, over the last several quarters, but you know, as Brian mentioned and talked a little bit about our concerns about the market valuation, which now has come back more to almost closer to a long-term historical average. We've got the potential for higher interest rates. Interest rates are at really all-time lows. The only place they can really go is higher, but we don't. The problem is, of course, we don't know when that is. With the generation and creating money that the government has done, you know, that is certainly a risk for higher rates of inflation. We have a continuing weakening of the U.S. dollar, and of course, you know, the foreign country debt issues and what that impact has been. You know, each time that Greece or France or Spain or whomever it might be ends up in the news, you know, you can almost bet that our markets are going to be weakened a little bit because, you know, they have some significant debt issues that they're dealing with, and the United States has its own debt issues that we're dealing with. So all these things kind of continue to lead to, you know, the concerns that we've been talking about for some time.